everybody. Welcome to TraderMerlin Show for your Wednesday Hump Day edition. The Fed announcement day. Some good stuff out there and some crazy market moves. I don't know if you guys saw my Twitter post, but I was laughing so hard when I saw the announcements happen. These massive swings up and down, and of course, continuing to move to the upside. I posted a picture of a woman with a big neck brace, and I said, this is the official attire for FOMC announcements. It was kind of fun to see. Anyway, check that one out and interact with it, I guess. My name is Merlin Rothfeld. You guys are new because I know we get some new people here on a regular basis. You can always hit that subscribe button so you know when we do the show, which is every day live at 2 p.m. Pacific time. And of course, you can always email me with your questions, suggestions, feedback, whatever you have at TraderMerlin@gmail.com. All right, let's start things off. I'm going to get moving and dive right into it. I wanted to have some fun with the graphic for today's show. And I thought this was a good one. That's all, folks. The end of cheap money. You know, we've been talking about this for some time, and all of a sudden, you're getting an abrupt end to cheap money. And of course, we've talked about this over the past couple weeks, actually months on this program, that the slowdown is coming due to inflationary pressures. And of course, we have Jerome Powell speaking today and giving his giving his insights from the committee about where they think things are going to go. And I thought, well, I'll talk about that. And then I got a question from a viewer, and I thought, you know what? Why don't we do a twofer? The numbers that came out today obviously are going to be important for steering the markets. And Melissa asked this question. I thought, you know what? I'll do a compare and contrast. So I'll set the stage for what's happened in the past, because I get this all the time from you as well as others in my circle of influence, is what lesson from the past can we draw as a parallel to today and learn from that, right? Were there actions that we could have performed in the last period of time we had this similar information? And I think that there are. So let's go to the question. The question was from Melissa. It says, when was the last stagflation in the United States? Was it like today? Well, conveniently, I went out and did some digging and brought up a whole bunch of images of the last time that we had one. Now, it wasn't really in my lifetime. Well, let me take that back. It was in my lifetime, but I was just a wee little lad and didn't really know what the hell was going on. I was a hippie running around naked with my parents out in the forest somewhere. But, totally different story. In the 1970s, we had stagflation, which a lot of people will chalk up to kind of multiple components. Number one, in the 1970s, you had significantly increasing oil prices, and I'll show you what crude oil did. Here's what crude oil did back in the 1970s. So the charts I'm going to show you here are from 1965 to 1985, so a 20-year window. And you can see in the late 60s, it was drifting down, and then all of a sudden in the 70s, we see big increases in West Texas Intermediate. So all of a sudden, crude oil went from $20 a barrel all the way up to, 100 and change. That's crazy price increase. So that was one factor. And of course, if you look out there today, let me bring up, I don't have TradingView. I'm going to try to do an easier flip for me. Didn't have this all prepared as I was getting ready last second to do this. And let's go to crude oil. We'll show you that chart over here on my second screen. And here is your crude oil. And now I don't know if I can go back that far. Now, actually I probably can. I can go in the 90s, but let's just zoom out here. This is a monthly basis, and you can see what's happened recently on a monthly basis. You have a very sharp spike in oil. Now, it might not seem as long and prolonged as we saw in the 70s and 80s, where it shot from 20 to over 100, but we did see it drop from negative 40. Of course, this is the ultimate outlier of all time. We should never see that again. We were somewhere, let's call it $20 a barrel, and now all of a sudden we are back up to 84. So I would argue you are seeing a somewhat similar spike in oil due to global demand, supply, whatever you want to chalk it up to, inflationary pressures. But that was part of what we saw in the 70s. That was one of the ingredients for stagflation. The second piece was inflation. So unfortunately, the Fed has decided to use a different metric. The Fed likes to use PCE, which is a different measurement. But back then, core CPI was the measurement that we use, and that's the measurement I look at. Of course, I'm not a Fed member, so my opinion doesn't matter. Right now, core CPI in the United States is running right around 4.9%, while the normal CPI numbers are running at about 6.8. So it's about a 2.1% or 2% difference between core and the normal number. And for those that don't know, core CPI and regular CPI. Regular CPI includes food and energy. Core takes that out. So what's our chart look like for the 1985 window? it's not that bad. I mean, you notice, I think we're in a similar situation to here, like 1965 to 1970, where we breach above that 5.0 mark. I think the next meeting we'll break above that 5% mark. But you notice the 70s, 74 and on, we were consistently above on CPI, spiking in 1980 up around a 12.5%, or sorry, 13.5% in 1980. I think we would all agree that things would be very, very, very different if we had a CPI number of 13.5%. I mean, this would be extremely bad for the United States economy and global economy for that matter. So are we there now? No, we're starting off, right, where I think we're just getting those wheels spinning because we've seen that price chart start to spike over the past couple of months where we were down around, 1-2% on our CPI numbers. Now all of a sudden 6.8 for CPI and 4.9 for the core CPI. So it's starting, it's moving. Good morning, Glenn. Good to have you with us. Yes, I cannot move the market. Honestly, in the grand scheme of things, I'm even more insignificant than a mosquito on the back of an elephant. I am absolutely irrelevant, but it doesn't matter. I'm just going to trade my money, and hopefully my assessment will allow me to make more informed decisions. So, and I don't want to be one of the policy. I would hate to be Jerome Powell. Absolutely hate it. So the inflation side of things, I think that is a parallel that we do have with the 1970 stagflation argument, right? You've got rising oil prices, we have rising inflation, which is what we have going on right now. So those two things lined up, sure, we could say we have some parallels. Now here's where the big difference is. I'll flip them. Growth is obviously an important one. And with stagflation, what you're looking at is growth going rather flat, right? And if really for this entire 20-year window of time, you really didn't see much growth over 5%. It was actually much lower than that on average. So this, how does this tie to our markets right now? Well, let me bring up a GDP chart just so you can see. This one up over here. I've got multiple screens going on. There we go. So here's our GDP. And unfortunately, I don't have it going all the way back into the 60s, but you guys can see here going back into 2020. The average, I'll put a horizontal line, which I think is right around average, looks to be about 2%. You guys can see where my cursor is at. It seems like that's running through the most points. Yes, there's some above it, there's some below it, but nothing more than 2.5%. I'll show you in a second what the Fed is thinking about their numbers. They're actually forecasting 5.5%, to which I respond, you need to put down your crack pipe, Mr. Powell and committee, because it's not 5.5%. I mean, not yet. Our supply chain disruptions are going to prevent that from happening. So thought that was interesting to see that, kind of flat growth or lack of growth with regards to GDP is definitely a major component. And I would say that we are too early to tell, right? Our numbers right now are higher than the 2.5 I mentioned. The last number you see here, we came out at the expected was 2.2%. We came out at 2.1. So we're definitely lower. Hey, good to see you, Jerry. And others. I didn't give a shout out to everybody because I really wanted to get through a whole bunch of stuff. And you guys can ask me all those individual stock questions. I saw Tokanata and others. Send them in near the end. Let me get through this inflation or this macro piece, and then we'll dive into the markets and look at a whole boatload of charts. Okay, so that's your second piece was GDP. I think it's still too early to determine whether we're going to have stagnant growth, but the next few quarters will give us a better clue. Next, you have unemployment. And unemployment in the 60s, 70s, and 80s, you can see was rising. Honestly, I don't think it got that high. You look at 1982, you're up around 9%. In the mid-70s, 75, looks like we're right around 7.5%, 8%. Not the end of the world. Now, we're obviously way better than that right now, and I'll show you some unemployment charts here in just a second. So generally, with a stagflation type environment, it's reflected with higher unemployment, where people just are out of work. And again, it's a cyclical machine, in my opinion. So what do we have next? What did I have next? Oh, yeah, and then the Fed funds rate, right? Somewhat interesting. There's a couple pieces here we should definitely pay attention to. Number one is this Fed funds rate, because we are right now where? We are stuck at zero, and we have been there for an incredibly long period of time. So that's probably the biggest difference is back in the 70s when we started to experience stagflation. In the early 70s, the rates were rising up. Where are we? We're down here, and we're just stuck here in this red line at the bottom. I mean, you're really just glued to the bottom. And as we start to see unemployment start to rise, we start to see the growth decline, we start to see inflation rising, right? They're going to have to raise these rates. And we should start to see charts that are liftoff. And now, do we get to 5 or 10% on Fed funds rate? I think that's just crazy. Late 1970s, NYC was very close to defaulting. I'm sure a lot of people were, right? How can you possibly sustain a business or an economy when you're running at 12%? I think it was 13.5 right here where I have that little red circle. Crazy. I was literally like, clickbait. It is the end, Brendan. This is the end of cheap, easy money, and that's what's been fueling all this gigantic, massive bubble. Oh, yes, it will. Yes, it will. I'll take your wager on that one, Brendan. We'll bet some crypto on it. I'll show you some charts here in a second that just shows you kind of the panic mode of the Fed. They're not gonna, they don't have to, but they will. So there's your Fed funds rate. Now let's go to the next piece, which is during that window of time, I just want you to look at what the S&P 500 was doing, right? So it sounds apocalyptic. It sounds like this, sky is falling, because in the 1970s, you had very high oil prices, you had unemployment was on the rise, you had stagnant growth that wasn't really going anywhere, and you had your CPI and inflation numbers were spiking. The market, you would think, would be selling off because of all that. Really? Okay, well, let's look at a price chart. I mean, to me, the price chart is what matters. Well, here you go. Flat. Right? I mean, granted, there were some big swings. The S&P, going back in the 1970s, we peaked out at like 120. Here, you see 120, and then all of a sudden we dipped all the way back down to 60. So this was a 50% decline in the price action of the S&P. So it's not to say there wasn't any swings, but overall, where do we go? We didn't really go anywhere. We went from in 1965, call it, I'm eyeballing these, 85 to at the end of that little box, over a 10, 12, almost 15-year period, definitely an increase, but not a ton, right? Not a ton. So it does continue to move up. And remember, in the 1980s, we even had higher rates than that. We were up around 16%. Now, let's go to what the Fed talked about today, right? Because that's all the parallel. That's all saying, what can we learn from history? The last time we had stagflation in a meaningful way was in the 70s and 80s. And what did they do to combat that? They just went straight raising rates, jack it up, and remove money supply, which is the moves that were announced today. So I thought this was rather humorous, because I actually do believe that they are not showing you the actual data or the numbers that are important for us with regards to growth. So let me embellish on that. These are the slides directly from the Jerome Powell press conference afterwards. I snagged them right out of the presentation from the Federal Reserve. Changes in real GDP. I love this, because this is how ridiculous our whole financial institution is. So here's your GDP. It says actual, all right? You got your actual number right there. You can see it was 2, rallied up to almost 3%, and then cratered because of COVID. You notice that it was actually falling before COVID. Here's, if I kind of go straight up, it's not the straightest line, but you can see that's 2019, right? So it was falling before COVID, and then we went negative. Well, are we seeing right now GDP growth of 6% in 2021? That's the expectation. These are all projections. So anything to the right in 2020, so they can't even update it into 2021. We're literally here on this timeline, and the Fed is still showing us charts of projections of 5%. It's ridiculous, right? That is so stupid that they can't even give us current data. I believe the reason why you're not going to see current data from them is because they don't want you to see it, right? They know it's not where it's at. Now, even if we do have these projections met, that's telling you that next year we expect it to be at a high point. We'll call it 4.5% to a low point of, let's say, 3.25%. Okay, that's your GDP. I mean, if everything clears up, if we get supply chains going, if Omicron doesn't turn into Gamma Theta, whatever next variant is going to be of COVID, and we go back into lockdowns, and supply chain gets fixed, yeah, we could very well see unemployment or GDP numbers back above 5%. However, the data is not supporting that right now. I can look at the actual data right here. This is preliminary GDP numbers. We're at 2.1%. That's nowhere near your expectation or target of 6%, which the committee has said that they're going to do. So again, as Brendan says, lying. Okay, next, unemployment, right? In the 80s, we had high unemployment. Well, we did also have high unemployment. Unfortunately, I don't have the current chart here, but I'm going to grab it for you because I do have the technology, and I'll go back and show you our next unemployment number. Here is your chart of what the Fed says for unemployment, right? So it says actual, and then it says, oh, we spiked in 2020 to like 6%. Did we really? I'm pretty sure we went higher than that. Let me get the unemployment number here. It's going to take me a second because that usually happens on Fridays. And I got to make sure I get that day. Unemployment rate. Bear with me as I'm scrolling through. Here's your unemployment rate. So right now we're running at 4.2 unemployment. Great. That's actually pretty good. And you can see that the forecast, and here's your unemployment right here. Here's the chart of actual data. So it's interesting that the Fed on this chart here shows you actual has peaked out at 6.5%, right? This peak right here, 6.5%. So what data did they pull from? Because this showed me getting unemployment up to 14%, and then I had 12%, and then I had 11 and 10. There's really no way that you can tell me that was the average. No, not for 2020, my friend. Maybe if you average in this 3.6 that we had. Anyway, I don't believe the data that's coming out from. They didn't make up the current data yet. Nice one, Alan. That's good. I agree. So this is where we're at. I would argue, 4.2% unemployment is fine. I don't think that this is bad. And this is where we differ from the charts we saw of the stagflation of the 70s and 80s. Unemployment was much higher than this. And granted, we may see this change, but right now the trend is your friend until the bend at the end. And look at what's going on right now. It's just making lower highs, lower lows. So, all things considered, you would think that unemployment would continue to drift lower and lower as it has done here on this chart. So that to me is where we differ with regards to the 70s and 80s stagflation discussion. But wait, there's more. If we look at, dagnabbit, I didn't put the price projection in there. One sec. I had PCE price projection and I forgot to put that one in there. This is this was GDP. So what did I get when I moved too fast? Let me bring this one up for you. Try to put all these things together without any development team and stuff. Let's go. This should be PCE. Okay, so here's their inflation projections. So their inflation projections, here's your actual, right? Okay, well, we hit 2% and then it's drifting down to 2020. And then, of course, 2021, we got inflation of 5.5%. Hey, Mr. Powell, we're at 6.8% on inflation. That's the last number, so update your data. Jerome Powell is just ridiculous, right? And the expectation is that inflation by 2022, which is in 1 month, that we will have an inflation between 3% and 2%. I beg to differ. I think that's a bunch of hogwash. In my mind, there's no way you're going to aggressively stop it so quickly and get it down to those levels, especially when you're consistently buying. Right now, well, they've dropped, right? They were going to taper $10 billion a month on treasuries and $5 billion a month on agency-backed mortgage-backed securities. They've doubled that. So today was like two-step. Okay, horrible example. I don't know if anybody saw the press conference or read through the data, but in October, the Fed said we are going to start tapering to the tune of $15 billion. They were currently, at that moment, buying $120 billion a month. 80 of treasuries, 40 of mortgage-backed securities, combine that for 120. They said we're going to cut back $10 billion a month of treasuries and $5 billion in mortgage-backed securities to slowly get us out by mid-July. And they doubled that today. They said, we're going to double that we're going to taper $20 billion a month of treasuries and now $10 billion a month mortgage-backed securities. People like when I make analogies. Have you ever had that moment where you're walking in a public place and you just ate like a burrito on a street in Mexico or something, and you're like, oh man, my stomach's starting to percolate a little bit. And you just turn to your friend, and your buddy's like, hey, I need a restroom. It's not urgent at this point, right? You're just kind of, we'll find one. Well, what just happened today was that moment where you pucker up a little bit and go, I need to hit a restroom now. And I think that's what Fed and Jerome Powell and the Fed did today, was basically go, oh crap, we have to start tapering, because they're not going to start to raise interest rates until they taper and get their purchases down to zero. They wouldn't double dip those two, right? You want to taper out. And if you guys saw the interview after the press conference, it was awesome. Steve Leisman of CNBC asked some great questions. He says, Mr. Chairman, you have stated that you're going to start tapering and slow this down, but you've also said that inflation is substantially higher than you anticipated. Why not just stop the purchases altogether, right? You know that this is not going to have an impact and solve any of the inflationary problems until you're completely out of purchasing these bonds and treasuries, right? You're not going to help the system by slowly tapering. You need to stop buying these because you're propping this market up and creating more inflation. And Powell goes, well, we don't want to shock the system. You know, it might be too much at once, so we're going to slowly taper out. And I thought it was great. I absolutely loved it. I was like, man, you don't like Steve Lee Smith, Brendan? He's not one of my favorites, but he's all right. I liked his comments and questions today. But you know, when they taper and finish tapering, which should come sometime in March if they speed up this tapering as they want, at that point, you're going to start to see rate increases. And Brendan's going to say they're not going to raise rates. That's okay. I beg to differ. And we can make a wager on that one, Brendan, if you like. I'd love to. Once they are done tapering, you have a couple systemic problems now. If you look at the yield curve, which Brendan has been referencing, and I'll see if I can find you an animated yield curve. Let's bring this one up. Make sure I got through all my data over here. Oh, that was that one. Okay, here's your animated yield curve. Bear with me. You really think I should have all this prepped before? Okay, and here it is. So here's your yield curve, right? This is where we are today. And you remember they were buying $80 billion a month of the short end of the yield curve. They're buying treasuries. So if they stop buying this over here, what's going to happen? This short end is going to rise. It's going to start to rise rather quickly as they stop purchasing. And if you want proof of that today, you did see the bond markets jump. Here is your 10-year today. Here's the 10-year. It did have it's funny, it was, this is monthly. You did have a spike up today, but now in the new session starting to roll over a little bit. But you had a spike up in it. And again, I still think that we are in an ascending triangle here. We'll know better if we start to break above this 1.7% on that 10-year. But bottom line is it's building pressure. It did not break this little kind of upslope. So to me, this is still in play. This will be the big factor. And if they stop buying the short end, this is going to start to rise as well. Now keep in mind that 10-year is over here. Right? That's this part of the chart. They don't necessarily control that. But the more that this short end rises, which the Fed does control, the more likely you're going to see these other ones rise as well, which could lead to the dreaded inverted yield curve. And who knows if or when that's going to happen. But if they do raise rates on the short end, that opens the door to a potential for an inverted yield curve, which could be, right? Which could definitely happen. So there's your yield curve. Right now it looks fine. I mean, there's nothing out of the ordinary here. I'd like to revisit this maybe June of next year because my guess is you'll no longer have the short end at 0, right? This short end by June of next year, my guess is going to be at least 50 basis points, maybe 75 basis points. That would be 2 or 3 increases from this point right now. Now, yeah, I don't know. I disagree, Brennan. I'm not worried about the MMT. I think that they're going to raise because they're in a tough spot and they have to. So you might remember at the previous press conference in September, they expected to maybe raise one time next year, right? That was the talk track. And I said to you guys over the last couple weeks, how many did I say? I said 2, possibly 3, right? Here's the new forecast. Okay, and this is based off of conversations and voting members of the FOMC positioning themselves saying, here's what we think. Check out this chart. This is the dot plot, interest rate forecast. You can see right here, 2021, no one's making a change. So we're getting nothing this year, no problem, we get that. All of a sudden, boom, in 2022, that's in the red box here, nobody's keeping rates the same, not one person. You have one person said raise 25 basis points, 5 people saying 50 basis points, the majority of the team saying 75 basis points, and then 2 people saying a full percentage point. A full percentage point. That's 100 basis points by the end of next year. Now, if inflation, I think we'll probably see 3. So I'm in this 75 camp here, right? I'm with these guys right there. That's kind of my thought. Unless inflation does continue to get worse, I don't think they'll go any higher than that, at least for next year. But the point I mentioned was, in the top of the show, I called this show the end of cheap money. See, I have a whole bunch of charts here, but I just love this graphic. The end of cheap money. That's all, folks. This is what I'm talking about. If those interest rates rise and we see the Fed funds rate number start to spike like this, then that means that your 10-year is going to cost you more. That means that your mortgages are going to cost more, your car loans are going to cost more, and all of a sudden, it starts to choke the economy. So that beginning of the end is not just for the bond markets. I think it's going to be for the equity markets as well. It just is a question of when. And notice their next 3 years show us getting potentially up to 3%, right? That would be pretty, I mean, it's still long-term, not the end of the world, but it's definitely much higher. And most of us have been used to this cheap, free money for a long time. Really, since 2009, we've been stuck at zero. Granted, we had a couple little spikes up to like 0.5%, but we haven't been over 1% in forever. All right? Especially you younger folks who are just getting in the financial markets. We've been stuck at under 1% for the past 20 years or so. It's kind of crazy. So, not 20 years. Has it been 20 years? 2008? No, call it 13 years. Anyway, dots rule? I think so. I'm a big fan of dot plots. Can the Fed members and their dots override J-Powell? That's a great question. I'm going to have to ask Bill Addis that one. If you have a preponderance of the panel, let's say J-Powell thinks at the next meeting we should only raise one. J-Powell says we shouldn't raise at all, but the vast majority of the members say that they should raise by 25 basis points. You would think that they would overrule, but I don't know. I'm not 100% sure how that all works. Back to not using so much margin, Jay. I'm not even going to say that. I'll tell you what, if things start to roll over, and they haven't yet. I mean, you saw the way the markets reacted today. I mean, what a gorgeous rally off of that announcement. So here is your equity markets. Let's start off with the S&P. You're looking at a 1.6% move. Look at that. Bam, we were right back. We had two down days, looking ugly, and all of a sudden erased all those losses and ripped right back up to that yellow box. Again with the yellow box on the TraderMerlin show. But that's your S&P. It looks great. And I'm not saying it's done yet, but the warning signs are getting more and more intense with regards to constraints for the market. Here's your Dow Jones Industrial Average, similar move. You had the S&P or NASDAQ. I'm loving it because I sold some puts on the Qs that are expiring Friday. Got to get my very nice quick rate of return on that one. You had S&P. Pretty much everything bounced on that. You saw Bitcoin today as well, and a lot of cryptos. So there was definitely a risk-on type of approach, which is interesting considering the Fed has pretty much said, we are backing off on stimulus. We're not going to buy treasuries. We're going to end up being completely out of mortgage-backed securities, which hurts the housing market. And then we'll potentially start tapering next year. So to me, he's telegraphing punches. He's saying, I'm going to start choking the market a little bit here because I want to make sure inflation doesn't get too out of hand like it did in the 70s and 80s. At some point, we'll get a crash. Or at least a significant pullback. I don't believe that we've had one, right? And that goes into this comment and question here. Let me read this one. Angel says, I'm an OTA grad and fan of the show. I was recently scanning stocks and noticed a very large amount of companies have not only fully recovered from the COVID market dip, but in many cases doubled and tripled in price. I know this all has to do with fiscal policies during the pandemic. Can you elaborate on how we got here, where we are going? Are we in a bubble? How much of a dip you're expecting? It looks like it's setting up for a huge crash in the markets. My answer has been watch some of the previous shows, Angel, because we've been talking about this a lot. I do think we are headed for a huge market bubble crash. I think, again, the Fed has put themselves into a corner that has been fine. They can just print money and they can keep stimulus and they can buy mortgage-backed securities, they can buy treasuries, do whatever you want, increase money supply by almost $17 trillion in 2 years. There has been no recourse. There's been nothing that's damaged that. So they continue to do it because it's not broken. If it ain't broke, don't fix it. Keep printing money, keep stimulating the economy. Now all of a sudden you're getting inflation spiking and surging. It's like, okay, that's a sign that we have to slow this down a little bit. But they're already addicted to spending so much money. It's pretty crazy. Margaret. Tips jumped today. Again, you saw the yields of treasuries. The 10 and the 30 jumped about, I think, 2.5% today. I think it could go more. I think you could see a lot more, but that was just the knee-jerk reaction to the comments. So, Angel, yes, we are in a bubble. We are in an absolute Fed-created bubble. We are in what I believe is the perfect storm of bubbles because you have a bond market bubble, an equity market bubble, a housing market bubble. Hell, some could even argue a crypto market bubble. I think that's different because it's a brand new asset class that still has a lot of legs underneath it. But the equity markets, I mean, Apple. Look at the chart of Apple. Right? This right here, I think it's 188 would be a $3 trillion market cap. Okay. Well, if you look at what's happened since COVID, let's go back to the March lows of 20. Why does always March seem to be the year? If you go back to those highs, Apple pre-pandemic, at its peak, this is before COVID hit, was trading at $81. Now it's 180, right? Is this all because of eat cheap, easy money? No, I think it's just Apple leveraging in, buying assets, and just basically reinvesting in themselves and making smart decisions. But there's a lot of companies that benefited directly. Amazon, right, which has been kind of flat lately, not the greatest chart. But here is, Amazon chart. They were back before this all started at the peak. I'll go actually back here. They were trading at $1,900, and now they're at $34. And you're right. A lot of companies have doubled, tripled, quadrupled in value. And to me, it begs the question of, is it deserved, or should this be a big correction coming? And the biggest ones to me are these stupid ones like GameStop, right? And of course, I know I've hammered on this one a lot. GameStop is still trading at $148 a share, when before the pandemic, actually way back here, we were trading at $7. I mean, this was a short squeeze, I get it, but AMC, movie theaters, especially now with the mask mandate going back on, I think a lot of people are going to say, not going there. You're still trading at $25 when the highest this thing has ever achieved in its history pre-pandemic. Actually was higher. We're at 35. Okay, all right. But they were falling out of grace. Anyway, let the Christmas rally begin. Hey, you know what? Let it. I'd love to see this market rally through the end of the year. Usually you do get some profit taking near the end of the year for tax sale reasons, but Energy watch us be higher. I think we'll have to wait and see what happens in January. I'm not. I do think that January is going to be the quote unquote the beginning of the end, but that's just my thinking. I think that you'll have, again, Naum says Santa Powell. Sure, yeah. I think December will probably finish on a positive note. I think it's all social behavior. Let's keep them warm and fuzzy, and then all of a sudden, you can't stop the markets overall from doing what they're going to do. You can influence it for a while, but when those chickens come home to roost, as they are right now, in my opinion, are right soon, right? Inflation at 6.8% isn't the end of the world, but if all of a sudden it gets to 10, now all of a sudden the Fed's like, we have a lot of work we got to do with regards to reining that in. So, Angel, I do think it's setting up for a huge crash, and the question is, where's it going to go? I don't know. I have no idea exactly where. These are the levels I have mapped out right now. There's some more I'll put on here if need be. But if we do just a simple fib retracement from two different places, number one would be from the low of this 2020 crash that we saw back in March, all the way to the peak, right? Does this line up to anything? A 38% retracement of that move would put me right at a 20% decline in the market. So that's where I think we'll be headed first, is this 38% fib retracement level, which coincides with a 20% pullback. The next one is pretty much in line as well with my level down here at 3,200. Right, that would be a 61.8% retracement. But that's just the most recent move, right? I think it's better for everybody if we take a peek at the bigger picture, because this isn't just because of the pandemic and that move. This whole move is one big move. And again, those numbers line up. The 38.2% lines up exactly with the 3,200. So that becomes kind of my big number I'm looking at, is the 3,200. Right? I still think 3,200 is the goal. Can we have it crash up? Yeah, absolutely. If you guys remember, Jeff Manson was on the program. I think I forgot the exact number. I think Jeff Manson was saying, 5,500 was his target for the S&P. Could we get there? Sure. Yeah. Nothing's out of reason. I mean, you look at the data and facts suggest that there should be some correction on the market, but everything works until it doesn't. Right? Trend is your friend here, so stay with it. I will probably in January begin building a bigger short position, or maybe even the end of the year in December, starting to build a position that's going to be coming to roost back in July. July, I think we'll start to see definitely downside movements, especially if once they unwind and they get the balance sheet from the Fed and they're no longer buying assets. I think that's going to be a big punch to the gut for the markets, because you no longer have this anchor, this prop pushing it up, right? It seems like every time those asset markets fall, they're like, no, we got you. We got you. Don't worry, we got you. We'll keep pushing. I think once that's gone, then you have a little bit more nervousness, right? You have a little more nervousness that this market may not be able to sustain the upward trajectory that it's been in, and then all of a sudden people start to take profits, and then things start to fall quicker, and then you go, oh no, we don't have economic growth, and then all of a sudden we start to see rising rates, pure inflation. It's just this giant cyclical piece that runs. So, all right, now let's see. What do you guys got for questions? James says, the thing is, everyone complains about the Fed doing stuff, printing money, keeping rates at zero, but no one wants to see what happens if they do nothing. Don't say no one, Jay. I think Brennan as well, I would love to see what would happen if the Fed was not involved in this whatsoever. If they did not do any purchases, they didn't increase money supply, they didn't do nothing like that. That's called free markets, right? That's where we should be. We should be in a free market environment. This is a completely manipulated market environment. There's no freedom of these markets to do what they're supposed to do. They're doing what they're being told to do, right? To me, that's it. Let's see. Where is Brendan? Brendan, do you seriously think they will be done monthly purchases next year? I believe that they're going to tell us that they're done, right? And here, again, Brendan, the reason is if they back themselves too deep into this corner, they have to have an out. And they can't raise rates if they haven't finished their taper. So I think they're just going to try to clear that as soon as possible because they can always start tapering again or buying more securities if everything calms down. But you have to clear your way. It's kind of like I can't fire my gun until I turn the safety off. Well, the safety in this case is let's get our balance, let's stop buying, right? So we're no longer purchasing. That way, that impact to the market is we can see what's going on month after month. We'll see if there's an impact to us not buying treasuries or mortgage-backed securities. If all of a sudden things are still dire, then they can start to raise rates. So it's no guarantee they're going to raise rates next year. We could miraculously, all of a sudden, inflation falls back to 2% and everybody goes, okay, we're good. Let's start buying again. But I do think we would have a painful winter, but I do think that you're going to see tapering done first part of next year. Please wait for some confirmation. Your big short position. Thanks, GD. Just that one. I've done really well with big short positions. That one was just a bad example. But hey, you know what? I took my shot. I'll take it again. I'm not worried. I'm not gun shy. Where was Jeff Manson? Jeff Manson is doing I think he's doing his own trading school now. So yeah, he's over there. Harry Dent is saying we are going to have a very large vote. Well, keep in mind, Owen, Harry Dent he's been saying that for a long time, right? And as they say, a broken watch is right, CliK twice a day, something like that, some old saying. So he's been pretty bearish on the markets. I tend to agree with him. I actually had a chance to interview him back in, I want to say 2012 or 13 on Power Trading Radio. That was a lot of fun. Good guy. Michael says, beginning to raise rates in March aligns fairly well with the sell in May. Agreed. And I think the big wild card is what happens to rates. The tapering thing is one aspect, right? And all that will impact the yield curve, which I think is obviously critical. But when you start raising rates right away, you raise the cost of capital. So to me, that's where it really starts to get real if they start raising rates. And you know, the funny part is, and it's really showing how old I am, which is, I don't believe I'm this old. Like, I don't want to admit it. You know, you look back in 2000s and the 97s, 96s, most of you weren't really that active in the markets. A lot of people are new to the markets and they only know this move here, right? They only know that big move. This is the 2009 on, right? A lot of people were not really involved in the market. So if you haven't been trading for more than 12 or 13 years, you really don't know what a bear market is, you know? And these were pretty rough times where you had, you know, over a year of just nothing but downslide. Well, what happens if we find ourselves in another year of nothing but downslide? You know, I know Brendan will say, oh, well, the Fed will stop it. Well, they tried. You know, at some point, the market will do what it has to do. You know, there's a very interesting interview I saw. And you guys, some of you might know the name Robert Breedlove. Robert Breedlove is I don't know what you call him. He used to be an old crypto hedge fund guy. Now he just is a market analyst or commentator on Bitcoin and real money. What is money? I think he has a What is Money podcast. And he made a good point. He says, you know, you ever notice how in the US we have these huge fires, especially out here in California, which is, you know, close to my heart. I'm in California and I grew up in NorCal, which seems to be the fire hotbed of California. But we have these massive fires that destroyed 1,000 homes. And we had to call in people firefighters from Australia and all these parts of the world to help put out a fire. And he goes, the reason for that is because we're constantly putting out the little fires. We're constantly addressing them. He goes, in Mexico, when they have a little fire, they let it burn out. And what happens is there's a couple different economic impacts here from the fire aspect. And I apologize for the odd analogy, but let's ride it. If you have, if you let the fires, the small ones, when the grass hasn't gotten to be 6 feet tall, if you let those ones burn out, not only do they not cause as much damage, but they also don't damage the earth because the temperatures don't get so damn hot. When you have these huge, massive fires, and the reason for that is you're constantly putting them out, but the undergrowth is getting so thick and dense that when it finally does go, it goes in a huge way. So we have these massive fires that at a certain extent, they're a result of us putting out fires. It's just we've prevented the issue from being small, and now we've encouraged it to be a big problem. So, and the damage to Earth is that those fires are so intense and so powerful that they actually can burn the top layer of the soil, destroying nutrients. So letting a small fire do its thing, which is free market, letting that fire just burn itself out. Yeah, you can stand there with a garden hose and put it out, but let it get the undergrowth that it needs to get out of the way. That's where we should be. Unfortunately, the Fed is the fireman who's putting out any financial fire in our marketplace, which is causing the potential for a huge forest fire that's out of their control. And I know we think the Fed is impenetrable, right? That there's nothing they can do wrong. I think if we look at this price chart, it's pretty clear that they have done a lot to help these markets. And all of you, without exception, have paper profits. If you're in a 401k, if you're in an IRA, if you're holding long-term equities, you have made money, right? You've made tons of it, and you're probably in paper profits. A lot of paper profits in here. And those can go up just as quick as a NorCal fire. It can go away very, very, very quickly. Yeah, John, that's it. Yeah, as President Trump says, well, it's because those Californians are out there raking up the leaves. It's because we just didn't let the market, the forest fire, just do its thing. Instead, we keep preventing them. But anyway, I hope the analogy is you can see the parallel to the equity markets. The Fed's the fireman, right? And the Fed's been putting out fires. And not only has the Fed been putting out some, the fires, which would be unemployment. Oh, let's put that fire out. Let's put inflation out, etc. But they've been adding to these problems. It's not just they have just left them alone to take care of themselves. They're facilitating a much bigger fire down the road. And who knows when it'll come home to roost. Hopefully we'll have a great conversation and we'll be cheersing whiskey to those of you who capitalize on the nice downside move. What impact will this have on silver? Rob, my belief is it should have a positive impact on silver and gold and commodities. But, you look what's gone on with gold and silver. Here's your weekly of gold, and then here's SLV, which, I almost bought some more today, but decided not to. Notice we just double dipped right here. Talked about that $20 level. Great buy point. We came down, kissed it, and got a little bit of a hammer formation on a double bottom. That's actually kind of a poised position for a move to the upside, right? I know it looks weird because we're just drifting down with all the data you see here. It looks lower highs, lower lows, but a double bottom with the hammer formation. I think if we get above this candle with today, you got a good shot of challenging that 43 mark, which would be great for me, and potentially even higher than that. But I think gold and silver will do well in the long term. I get it, but we can't expect the companies, banks, automakers, injuries to do what is right. Yep, that's true. But do you think that those companies have done what is right because they're always going to be who they are, right? So you're going to have some good companies. You're going to have most of them are just slimy. I'm doing whatever I can to make as much money as possible. But what the smart ones are doing, your Apple, your Amazons, your Googles, is they're surveying that landscape and they're looking out there going, okay, here's how we're going to make the most money. And along comes the Fed and says, hey, we're going to give you this for super cheap. So they're utilizing the Fed at their maximum, and they should be. Why not? Right? You're going to give handouts for COVID? I'll take some of that money. You're going to give me real cheap capital with the Fed funds rate? Great, I'm going to take some of that money. Oh, and the 10-year right now is under 1.5%. I'm taking some of that money. Right? And the more you stock up that, the more it allows these companies to just accelerate their growth and get bigger and bigger. I don't fault them at all. They're just using the system that's placed in front of them to make as much money as possible, which is why we buy the equities, because we're trusting them to take that money and make more money with it. And they know that they'll get bailed out. That's another good one. Yep. Let's see. What else? Merlin, is it possible that the idea of pumping the markets was right because we all made money, but we didn't turn it over and spend enough to stimulate the economy? That's one thought, GD. I think that's actually a good point, is there's a lot of people that the expectation is with stimulus is that we should have gone out and stimulated the economy. Personally, and I didn't get any stimulus checks, guys, I don't qualify. But if I did, if I got any of it, if I got a $1,200 stimulus check, it's going in one place and one place only, and that's going to any debt that I have and to pay down that debt. Credit card debt, car loan, not a mortgage because those rates are so low, but anything that's going to be like 6% or above, I'm paying all that down with that $1,200 as much as I can. The government wants you to go out and buy stuff. Just spend. Go buy the new TVs. Remember when we got the first stimulus check announcement? Walmart had a huge ad that said, "Here's a 75-inch TV for $1,200." Basically, just drop your check off and take a TV out. Smart move on Walmart's part, but there's going to be those people that don't contribute it and didn't spend it. They did the right thing. You need to better yourself versus better the economy. I know that sounds anti-patriotic, but you know what? You got to take care of yourself first. The economy will always be there moving up and down. Your situation is more important than the economy. You can read the economy and you can make money in up markets, you can make money in down markets, and even sideways markets. But if your goal is, hey, I just need to support the economy, you're going to hurt yourself. You're going to spend money to support a system that is run by a bankrupt organization. If you look at our government, they are a $3 trillion deficit. This is one of the most poorly run companies, from a business perspective. It's one of the most poorly run companies on the face of the planet, or in the history of mankind, is the U.S. government, on how badly they are spending and running at a deficit every month. Any other business in America or around the world would be bankrupt by now. 100%. Guaranteed. Anyway, stop my rant. What other questions you guys have? Some of you wanted me to look at some charts. I got a few minutes left here, so let's throw some stocks out there. I saw we had a new person way earlier was asking about something. Let me go back to what that was. Let's see. He's probably not even here anymore, but you know what? I'll go over it anyway. It was Run. Tunkanata asked to look at Run. All right, let's check out RUN. Sunrun Incorporated. Okay, so I'm assuming solar. I'm looking at this price chart on a weekly. Not a fan. And the main reason is where we come from. We came from these nice lows down here around $8, had a huge accelerated move to over 100 in a very short window of time, and then all of a sudden starts drifting down, and all of a sudden we are making new lows. So to me, Sunrun, this is a weekly time frame. It looks like it's going back to the origin of this last big move, which is right around $20. It's at 36 right now. It doesn't look good. Hate to say it, but that's where we're headed, in my opinion. Looks like we're going down to $20 here. So there you go. Crypto, mortgages, credit cards, bills, whatever. Yeah, but invest in yourself, right? As long as it's making and improving your personal situation. I know, you all want to support the economy, but if you're in a bad financial situation, screw the economy. Take care of yourself, right? If you're a person who's got free flow capital, you have what they call FU money. You guys heard of that term, FU money? If you have FU money, yeah, go spend. Go there. You can do all that stuff. But until you are in a position where you can look and say, every month I am going to just do better and better and better, and I'm growing my net worth, and it's just a nice trajectory upwards, that's your main goal. Period. Who cares about politics? Who cares about anything else? Just take care of yourself. And then you can help the system. What else? Planter. GD, you tell me, does this look like a good short? I mean, we say the trend is your friend until the bend at the end. This looks like lower highs, lower lows. Commodities in general right now, Brendan says, look at agricultural commodities. Right now, in general, commodities are looking pretty good. I don't have a whole bunch here. You've got nice moves up in corn, which it's not, this is a weekly. I'm going to go back to a daily on this one to be a little bit more short-term time frame. I'm loving the commodities space just from the trends it's facing right now. Where food prices just going, period, right? Where are they going? Up. Food prices are going higher, no question about it. Remember we talked about those lumber chart? Look what happened to lumber. Lumber's up 100% in the past 3 weeks. Doubled in 3 weeks. This isn't Bitcoin, folks. This is lumber. This is wood. Wood. What else do we have? I don't really have a lot of stuff on this one as far as commodities. Soybeans not doing that great, but you can look at other ones. A lot of the commodity space has been doing great. Good to see natural gas finally pulling back, right? But I think as well. How many cryptos are on my watch list? Oh, I don't know. Probably 30, 40, somewhere in there. This isn't even all of them. I mean, I've got like 28 different positions in my portfolio, and I added a couple in here that I don't really have. Our all clean energy stock runs like, I don't know. I don't really follow the sector. No. Let me look at that on a different one, Margaret, because I need to get a whole list of symbols here. I got a couple in my head, but I'd like to get a broader representation of what that market looks like for all of us. So let's see what else we have. Planter for Rob. Oh, PLTR. Okay, Rob, we'll check that one out for you. PLTR, and then I got to run. All right, Palantir. Same thing. I mean, what's your trend since September? Lower highs, lower lows. The only thing here is you're coming into this sharp spike up that we saw going all the way back into May 11th of 2021. that to me is your stop point. So actually potentially a buy as you get close to that. We're at $18.92 right now in the post market. So if you get down to that $17 mark, that might be a buy point. But I think you got to be careful because the trend is showing weakness. You're catching the proverbial falling knife in there with Palantir. Okay. Buy KR. Got to buy food, right? All right. Kroger, one of the largest food grocery stores in the world. Yeah. Again, trend's your friend. You are coming in some overhead supply, right? It looks a little bit challenging as you get up here, but I need to run, put debit spread to keep my Zoom position from getting too lonely. How's this Zoom doing? Nice. To be expected, right? It's funny. I remember when I had Sam Evans on the program. We were both. I was on his program, and he was saying he's got a thing that's called Pick'em, where you pick somebody picks a long and somebody picks a short, and we both were like Zoom short. He's like, no, I want to do Zoom short. I'm, oh, okay, you can take Zoom short. I'll do something else. Yeah. I'm hoping he just got some direction on that one, right? I mean, we talked about how Zoom has got way too much competition, and you can see it's happening right now. You got to be careful with Zoom because it's already down so much. I mean, goodness gracious, look how much Zoom is off the highs, right? And we were talking about this for a while. Still am bearish on it, but at this point, you are down. Oops. From its peak, you're down 70% on Zoom. Shocker, right? Shocker. Mike, any reason to be positive cannabis? No. This has been a slow trudge down. You know, here's that MJ ETF back down around 11. I remember we talked about this, I believe it was here as we started to curl back up. And it's like, all right, this could be that potential, move to the upside. It never broke above 17. Just kept drifting lower. I mean, it's really kind of sad. I only have one cannabis position right now, but that's a long-term hold because my buddy worked at the company. It's done nothing but go against me, so I love that one. All right. I have to run, everybody, so I apologize for cutting the show short. Hood. Oh, Aiden. I have a lot. I'm disappointed. Oh, I hope you're not long, Aiden. I hope you're not long. Boy, this is... I'm not bullish on Robinhood at all. At a certain point, I think that they're going to get bought by somebody else just for their database, but I think that they're cooked. This trend has been ugly for a while, and again, I think that the SEC is going to change the rules with regards to payment for order flow. If they change that rule, Robinhood is dead in the water. Dead. Absolutely. Dead. So that's how they make all their money. If they can't sell their order flow, they're dead. They have no business model there. So that's how they became so popular. Oh, it's free. No, they sell their order flow. So I'm not a fan of this. I know it's probably not what you wanted to hear, Aiden, but this one's pretty dangerous right here. All right. I got to run, everybody. Thank you so much again. For those who might be new, I saw a lot of new names today, so apparently something's working. We're reaching some new people, so thank you guys for watching. If you are new, hit the subscribe button. If you liked today's show, found some good content, hey, give me a little thumbs up there. That always helps. Comments down below the video help as well if you are on the YouTube channel. I doubt anybody watching the video made it all the way to the end except my regular group that is here, so thank you guys so much for joining us. Hopefully we'll see you all on tomorrow's show, and again, if you want me to cover something, today's show was a result of the FOMC meeting, but also question from Angel and a couple of others about the market. So let me know what you want to cover. Send it in at TraderMerlin@gmail.com, and I will see you all mañana. Take care.